Good morning and welcome to today's webcast, GASB 87, Adoption and Best Practices for Government Entities. Before we begin, I'd like to cover a few housekeeping items. Today's webcast is eligible for 1.5 CPE credits. Per the National Association of State Boards of Accountancy, to qualify for these 1.5 CPE credits, you must attend for a minimum of 75 minutes and respond to at least 5 of the 6 polling questions. Your attendance and poll responses will be tracked in our CPE progress window. Once you have met all CPE requirements, you'll be able to download a copy of your CPE certificate in the CPE progress window. We will also send a copy via email within the next 2 weeks. We will be taking questions at the end of the presentation. To ask our speakers a question, please type it into the Q&A window and click Submit. If we don't have time to answer your question today, we will do our best to follow up with you after the presentation. A copy of today's slide deck and additional resources are available to download now in the slide deck and handouts widget. Finally, the material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. This information is not intended to create, and receipt does not constitute a legal relationship, including but not limited to an accountant-client relationship. Although this information may have been prepared by professionals, it should not be used as a substitute for professional services. If legal, accounting, investment, or other professional advice is required, the services of a professional should be sought. I'm pleased to introduce today's presenters from our Moss Adams Government Services Group, Olga Darlington, Partner, and Keith Simovic, Senior Manager. With that, I'll turn it over to Olga to get us started.
Thank you, Pam. Welcome, everyone, to our program today. Hopefully, at this stage, your organizations have started already to assess the impact of GASB 87 on your organization and the financial reporting and all the other implications related to that, and have started to look into the different terms that will be applicable in gathering the information to implement the standard. Our goal for today is to provide a brief overview of the basic concepts. What is a lease? How do you determine the terms? And then we'll dive into more practical application of reporting, lessee reporting as well as the lessor reporting, and what are the differences between those two. Later in the presentation, we have quite a few examples that are case studies that hopefully, one, will be interactive and fun for all of the participants, and two, will help trigger some of the examples that may be applicable to your organization and help answer some of the questions that you may have. We'll conclude our presentation with some best practices, especially some recommendations from the auditor standpoint. And we're hoping to have some time for Q&A, but as Pam mentioned, if we don't get to your question during our presentation today, we will certainly follow up after today. With that, we have our first polling question. When does your organization... Oh, go, Pam.
No problem, Olga. Yep, I can take
you.
The polling question here. Yep, so here's our first polling question. When does your organization plan to implement GASB 87? A, during the original effective date in the standard, for reporting periods beginning after December 15th, 2019. B, not until after the 18th-month postponement under GASB 95, for reporting periods beginning after June 15th, 2021. Or C, you're already implemented. So we'll give you a few minutes to respond. To participate, please click the button next to the answer you choose and hit Submit. And just as a reminder, if you'd like to receive CPE credit for today's webcast, you'll need to respond to at least 5 of the 6 polling questions. We'll just give you a couple more seconds. We'll leave this open just to give you some time to select your responses. And then I think we can go ahead and close the poll question. And Olga, here are our results.
Thank you, Pam. Well, it looks like most of you are deferring for 18 months as allowed per GASB 95, which is a great choice. I know many organizations have started their assessment already, so you're probably in that category of trying to just get it implemented on the original timeline, get it out of the way, but some of you may still need a little bit of time. So very interesting spread there. But and we have quite a few overachievers who have implemented. Congratulations to you all. And I'm hoping you'll get something out of this presentation today, other than CPE, that's helpful in your continued assessment of your leases. All right, with that, we'll cover the applicable guidance today that we'll be referring to throughout our presentation. Of course, the GASB Statement 87 itself that has all of the information. We will also be referring to Implementation Guide 2019-3. This is the Implementation Guide for Leases, as well as the Implementation Guide Update 2020 that was issued more recently in April of 2020, was covering some of the questions related to leases as well. And of course, GASB 95, the latest and greatest, allowing the postponement of the effective date for authoritative guidance for leases in particular. So we'll be referring to that guidance throughout the presentation today. So what is a lease? Once again, a contract that conveys control of the right to use another entity's underlying asset as specified in a contract for a period of time in an exchange or exchange-like transaction. And I could not memorize it, so I had to read that because that definition has a lot of key terms in it that really you have to pay attention to when you're looking at a contract to determine whether it meets the definition. First of all, contract, of course, assumes legal enforceability. Control of the right, I'll talk in the next slide a little bit more about that. Period of time, it cannot be a perpetual contract. It has to have stated terms. It could be a very long-term contract, up to 50 or 99 years, but it cannot be perpetual. And of course, exchange or exchange-like transaction assumes that the value is given or received in that transaction. It could not be nominal value. Implementation Guide provided some additional answers to questions, whether uninterrupted control is required for determination of the lease. And that question was particularly related to a multi-year contract that allowed access to the facility only 3 days a week, for example, or for a period of time, but on a consistent basis throughout a multi-year contract. And, pardon me. And the answer is no, it does not have to be perpetual. It does not have to be uninterrupted control in order for it to be a lease. Another common question we receive is regarding the easements, whether those meet a definition of the lease or not. And the good answer, of course, is it depends. Some leases may meet the definition of a lease and some may not. Particularly, those leases that are permanent would not meet definition, once again, because there is no stated period of time. And those easements that were not obtained in an exchange transaction, so where the nominal value was paid or that were received without any value exchange, once again, would not meet that definition. So when you're talking about looking and assessing easements, you really just have to look at the terms and circumstances for those particular easements. Control of the right. To determine whether the contract conveys control of the right to use underlying asset, both of the following criteria have to be met. First is the right to obtain present service capacity for use of the underlying asset. And the second is right to determine whether the nature and manner of the use of the underlying asset is specified in the contract, whether you can have that control. The criteria is pretty straightforward, but when you start looking at the contracts that you have, that control could be anywhere on the spectrum from no control to full control. So some judgment will need to be used by the organizations to determine whether both of these criteria are present in order to meet the control criteria. The standard outlines some specific instances that are scoped out of the standard. These are outlined in paragraph 8 of GASB 87. Intangible assets, biological assets, inventory, service concession arrangements, arrangements associated with conduit debt, and supply contracts. Now, when you're looking at the scope exceptions, I do have to warn you once again that with new GASBs that have been issued subsequent to GASB 87, the terms of this paragraph have been amended. So I'll talk about those in the next slide, but the one I wanted to highlight here is the supply contracts, particularly for power purchase arrangements. Before you scope out or conclude that the supply contract is scoped out, you have to look into underlying terms as well to making sure that that supply contract potentially doesn't give you the right to use the underlying asset, such as generating facility. So when you hear the term supply contract, before you entirely scope it out of the lease arrangement assessment, look at the underlying terms. So a couple of areas that are scoped out in the GASB 87 paragraph 8, but have been since amended in the subsequent guidance is the intangible assets, for example, IT software versus hardware. Under previous guidance, software licenses were excluded from lease determination, while IT hardware was included. That was amended by GASB 96, Subscription-Based Information Technology Arrangement. If you have had a chance to review that guidance, you will find some similarities to GASB 87 and treatment of subscription-based information technology arrangement, very similar way. So that's why the standard updates the exception in paragraph 8 of 87 for intangible assets, particularly software. Service concession arrangements versus public-private partnerships. This is another scope exception under paragraph 8, but once again, under GASB 94, public-private and public-public partnerships and availability payment arrangements that was issued in June of this year, updates that guidance. And so if you do have a PPP or a service concession arrangement, take a look at that guidance before you scope it out of GASB 87. Right, so looking at the lease terms, for reporting purposes, you start the calculation of the lease term with a non-cancelable period. To that, you will add any periods that are covered by options to extend the lease if it's reasonably certain that the option will be exercised, or terminate the lease if it's reasonably certain that it's not going to be exercised. You will exclude any cancelable periods, and these are the periods where both lessee and lessor have the option to terminate. It has to be for both sides, equal for both sides to be called cancelable period. Reasonably certain is not really defined anywhere in the guidance, so once again, you will have to use a little bit of a judgment there. And in subsequent Q&A, the answers to fiscal funding questions or cancellation clauses, the answer to that is that it should not have impact on determining the lease term. So when you're initially determining the lease term, some of the factors to consider is whether there's significant economic incentives to exercise the options, such as very favorable rent rate, or significant economic disincentives to terminate the lease, such as very high cancellation penalties, expensive relocation costs. The IG guidance questions we have referenced here are the ones that address those two specific instances. History of exercising options is not always needs to be considered, and that is also addressed in the guidance in the Q&A. When do you reassess the lease term? Is that when options exercised when in initial determination of the term, they were considered to be not exercised, or option not exercised when initially it was determined to be exercised? So this is when you have a remeasurement of the lease term and a potentially remeasurement of the liability. Quick touch on the short-term leases. These are at the beginning of the lease. Maximum possible term of the lease is 12 months or less. That includes any potential options to extend, regardless of probability. If contract has cancelable periods, use those cancelable periods, including any notices to extend. And once again, cancelable periods include those where lessee and lessor both have the option to terminate or extend. Some of the questions from the implementation guide related to maximum possible term when the lease can be exercised or canceled. Any optional periods, this is related to looking at how many periods and what are the options for terminating those. For similar 12-month long-term contracts being negotiated, or similar 12 months long that are being negotiated back-to-back. So the example for this question was, if the organization is negotiating a 12-month contract, let's say from January to December 2019, and then immediately at the same time negotiating another 12-month contract from January to December 2020, would that still be considered a short-term lease? And the answer to that question was, there is guidance in GASB 87 and paragraphs 69 and 70 for possible contract combinations. So most likely what the entity is doing is really just trying to stack annually the same contract, and that would be considered a contract combination. Another question from the implementation guide is the 3-year lease contract, but either party has an option to cancel that lease within 60 days notice. So what would be the term of that lease? And the answer was it's 60, really it's a short-term contract with 60 days because both parties have option to terminate. And back to the history of entering into a new 12-month lease contracts every year, this is a question related to marina boat slip rentals, where the one particular customer has been renting boat slip for 12-month periods for 20 years. He renewed it every single year. Whether that would be considered, that history of renewals would be considered in determination of the lease term, the answer was no, the history doesn't matter. It would still, as long as it's just a 12-month lease without any extension options included into it, it would still be considered a short-term lease. So take a look at those questions in the implementation guide if those circumstances sound familiar to you. How do we record a short-term lease? Of course, just recognize it as an expense by the lessee and then as a revenue by the lessor. Do not recognize any assets or liabilities or deferred inflows related to those. And I really don't have to include those any extensive in the disclosures. With that, we go to our next polling question.
Yeah, here we are for our second polling question. Approximately how many leases does your organization have? A, less than 10, B, 10 to 25, C, 25 to 50, D, 50 to 100, E, over 100. So again, just as a reminder, if you'd like to receive CTE credit for today's webcast, you'll need to respond to at least 5 of the 6 polling questions today, since today's session is a 90-minute session-long webcast. I'll just leave this open again for a couple more seconds just to give you a chance to respond. And just select the button next to the answer you choose, and don't forget to hit submit so that we can record your responses. All right, I'll just leave it, just give it a couple more seconds here. And I think we can close the poll. And Olga, here are our results.
Thank you, Pam. Well, the good news is with the standard is whether you have less than 10 leases or over 100, you still have to go through the entire step-by-step process of determining all of the complex parts of this leasing standard. So I think we have a good, interesting separation here of all numerous different, over almost 30% of you have over 100 leases, which of course brings its own complexities as far as getting your arms around how many contracts there are and how do we keep track of them, not only for initial implementation, but going forward. So this is an interesting statistics. Yeah. And with that, I will pass it over to Keith to walk us through accounting and reporting implications. Keith?
Perfect. Thanks, Olga. Thanks for kicking things off. So before we dive into more of the details of the standard in this section, I just wanted to take a minute to take a step back to discuss the background and really the why behind this accounting standard. We've had the same leasing standard in place for years now, where we have to make a determination of whether the lease agreement in question qualifies as either a capital lease or as an operating lease. And an operating lease, as we know, would require the payments made to the lessor being recorded as an expense in the period in which they are incurred. But really, no asset or related liability would be recorded on the books. And then on the other hand, if a lease qualified as a capital lease, an asset and a related liability would be recorded, and the asset would be depreciated, and the related liability would be reduced as payments were made, with, of course, a portion of the payment being recognized as interest expense. So you might think to yourself that, this model has been working pretty good up until now, so, why is there the need for the change? And the answer is really twofold. First, the standard setters follow kind of the underlying principle that all leases are really a financing mechanism of the right to use an underlying asset. And as a result of kind of that principle, GASB is moving towards a single model for recording leases rather than the current model of capital and operating leases. And then the second reason is that we're seeing more and more of a move towards convergence to international standards. So whether you're a governmental entity following GASB or a private entity following the FASB financial reporting framework, so as a result of that, you may have already noticed that GASB's new leasing standard is similar to that of the new FASB leasing standard that's going to be implemented in the near future as well. So you're definitely seeing kind of more and more of that push towards convergence on both the GASB and FASB side. So this new leasing model really results in the lessees, as we've kind of discussed, being required to record a lease liability and a related intangible or right to use asset upon commencement of the lease, while on the lessor side, the lessor would record the lease receivable and a related deferred inflow of resources on day one of that lease. And the new model, should be somewhat similar to that of a capital lease under the current model, and kind of just eliminates the concept of an operating lease. So I'll give you a little background. So moving forward, I want to dive a little deeper into the initial measurement of these items. And just to make sure we're covering both sides, we'll break this out between lessee accounting and lessor accounting to give you an idea of the mechanics for each. So first, for the lessee side, the value of the initial entry to record the intangible asset and the lease liability is based off of the present value of the future stream of lease payments. Now that kind of might, at first glance, might seem fairly simple, but depending on the lease terms, this could be a little trickier than it initially seems. So first off, the standard discusses what should and what shouldn't be included in the determination of future lease payments. So having a solid understanding of this will help you determine the correct starting point before we factor in any present value calculations. And then second, whenever a standard requires a present value determination, this typically means that you'll be required to identify an appropriate discount rate to use in the calculation. And sometimes that is easier said than done if the rate isn't stated clearly in the lease agreement, right? So, we'll provide some tips and guidance for both of these items in the next few slides, but for now, we wanted to cover some basics. And first, once the lease liability is determined and the related intangible asset is recorded, keep in mind that the intangible asset may also get adjusted for items such as prepayments, incentives received, or for any installation costs. Those will all factor into the value of the asset and will eventually be amortized over the term of the lease. So then switching over to the lessor accounting, the calculation described above would be similar for determining the initial entry to record the lease receivable and the related deferred inflow account, which would be calculated at the present value of the future payments, just like on the lessee side. The deferred inflow would be further adjusted if any prepayments are received, such as for the first month's rent or something like that, or if any incentives are paid to the lessee, much like with what we kind of saw on the lessee side related to the intangible asset. And then one more item that I wanted to mention before kind of moving on from this slide is that in a lessor situation, you would still want to leave the leased asset on your books and record depreciation on the asset. If the asset is something that is non-depreciable, like land or something like that, you wouldn't, of course, record depreciation, but you would still keep the land on your books. Now, this concept of keeping that asset on your books might seem a little odd since the lessee will be recording the asset on their books as well, so you really have this asset kind of recorded on both sides. But this ensures that when the asset is returned to the lessor, the asset's net book value is appropriately reduced to reflect the wear and tear that the asset has incurred over the course of the lease. All right, so moving on to this next slide, we wanted to illustrate what should and shouldn't be included in the determination of future lease payments. Now, I don't think there's going to be a lot of confusion over the category of fixed payments that we have on here, but if you have a contract that has variable payments that adjust periodically based on some type of indexed rate, how do you determine the future lease payments when future rates are unknown? In that type of scenario, what GASB 87 really says or clarifies is that future lease payments should be projected out using the current index rate. So there's no need to try and predict the rate in the future or to try and update the lease liability each year as a new index rate comes out. All you need to do is just use the index rate that is present at the commencement of the lease. So then what about if you have a lease agreement where additional payments may be required based off of something like usage? Well, one example of that would be if you had a contract to lease vehicles where the contract stipulates that additional payments would be required for every mile driven past a set threshold in the contract. Now, if that was the case, the standard states that those variable payments would be excluded from the determination of the future lease payment stream when determining kind of that initial lease liability. And another question that might come up if you had a lease that has variable components is, but is really kind of fixed in substance. For example, if you had a lease agreement for equipment where the payment is based off of the number of hours the equipment was used each month, with a minimum payment set at $1,000 each month, you would only want to include the fixed minimum of $1,000 in the determination of the lease liability. There's no need to try and estimate the hours for each month in the determination of the lease payment stream. Just use that minimum of the $1,000 for the determination of the lease liability. And then finally, keep in mind that any lease incentives that are receivable from the lessor or payable to the lessee should be included in the lease liability if you're the lessee, or the lease receivable if you're the lessor. Okay, so moving on, let's talk a little bit about the discount rate. So there are a number of different ways to determine the rate, kind of as shown on this slide. But there is an order of preference written into the standard to keep in mind. First, if it's available, you would want to use the stated rate in the lease agreement. Now that's the easiest and most preferred method in the standard. But I'd say, in my experience, many leases don't seem to contain a stated rate. And if there isn't a stated rate, the next step would be to see if the rate is implicit in the contract. So what does that mean? Well, let's say, for example, you leased a piece of equipment for a period of 3 years at a total amount of $500,000. Now, if you knew that the asset's actual fair value at the start of the lease was $900,000 and the actual useful life is 6 years, you would probably have the information necessary to calculate the implicit rate. So remember, this is something where the useful life is 6 years, value of the asset is $900,000, but we're paying $500,000 to lease it for 3 years. So in this case, the interest associated with the lease would be calculated at $50,000. Now, how did we figure that out? Well, given that the value of the asset utilized during that lease term would be $450,000, right? So we're leasing it for 3 out of 6 years, so half of its useful life, and the value of the asset is $900,000. So that's half of its value, so $450,000, but we're paying $500,000 to lease it for those 3 years. So we're paying $50,000 more than the fair value of that asset. So we're assuming that extra $50,000 is an interest component. So you have what you need to kind of figure that out. And then finally, if the information to determine an implicit rate is not available, then the incremental borrowing rate of the lessee would be used in that case. And for the lessor, if that's not available, then the lessor's incremental borrowing rate should be used. So quick recap on all that. First you want to use the stated rate if it's available, then the implicit rate from the contract if you can get it, and then after that, the incremental borrowing rates of either the lessee or the lessor. All right, so once you've figured out the initial measurement of the lease liability or the lease receivable and have recorded the initial entries, the next step is to have a clear picture of the accounting going forward. So let's talk first about the lessee side for this one. For the intangible right-to-use asset, you will want to prepare entries to amortize the asset over the shorter of the underlying asset's useful life or the lease term. So if you had an asset with a useful life of 10 years, but the lease term is for 8 years, you would want to amortize the asset over 8 years. And then at the same time, the lease liability would be reduced each month as payments are made, with a portion being allocated to interest expense for the period. Now we'll see some journal entries to give you a better idea and a better picture of what this looks like in the next few slides. And then the accounting on the lessor side is very similar, with the lease receivable being reduced as payments are received each month, and a piece of this going against interest receivable each period. And then the related deferred inflow will be reduced with a corresponding entry to recognize the revenue, which should be recorded each month and recorded, as GASB would state, in a systematic and rational manner over the lease term, which in most cases I would imagine you would just use a straight line method of amortization to make things simple. But then keep in mind that the actual leased asset will remain on the lessor's books and will continue to be depreciated, as we kind of mentioned previously. So moving forward, we'll see a better picture of the actual debits and credits that will run through the general ledger each month as payments are made by the lessee. These entries probably look pretty similar to what many of you already encounter if you have capital leases on your books. And in this example, a monthly lease payment of we've got $22,000 is made to the lessor. And with that payment, it's determined from the amortization schedule that $4,000 is related to interest expense, with the remaining $18,000 going against the principal balance. And then for the asset in this example, we're assuming that when using kind of a straight line method, again, keeping things as simple as possible, $15,000 in amortization expense will be recognized each month with a corresponding credit to the intangible asset or accumulated amortization. So both of these entries would look very similar each month going forward, with some changes in the allocation between principal and interest over the course of the lease as the lease liability is paid down. And then on to the lessor side to kind of give you a glimpse of what those entries would look like. Again, this is pretty much the mirror image of what we just saw for the lessee. So a $22,000 monthly lease payment is received, with the credit of $18,000 going against the principal balance for the lease receivable, and the remaining $4,000 hitting interest income or going against the interest receivable if the income had already been accrued for. And of course, the deferred inflow is also reduced, and the related credit for $15,000 is recognized as revenue each month using a straight line method over the lease term. So very, very similar to what we saw on the lessee side. So if you've got it down from one side, it's pretty much pretty simple to transfer over to the lessor side and see what that would look like if you were sitting in that position instead of the lessee position. So one other area we want to talk about that may present some challenges is the concept of lease modifications. Now, the key thing to keep in mind, I'd say, when we're talking about lease modifications is that, this would represent an amendment to the original lease contract and doesn't result from simply exercising options that were present in the initial lease contract. So if you determine that you do have a lease modification as a result of an actual amendment, the next thing to look out for is whether the amendment adds new assets to the lease. Because if new assets are added, then that would essentially represent a new lease, and you would want to go back through the analysis that we've already kind of gone through and described previously to determine the lease term and overall value of the lease liability and the related right to use asset. But on the other side of this, if the new asset or if new assets aren't added as part of that amendment, then the next step would be to remeasure the lease liability based on the updated terms of the amendment, such as an updated lease term or payment amounts, and then adjust that lease liability and the related right to use asset accordingly. And that'll get you in line with kind of the remeasured lease liability calculation. Now, one potential pitfall in this area is that if you do have a lot of leasing activity, you may have different departments that have knowledge of and manage different types of leases. Some of those departments may not be aware of the accounting implications of a lease amendment, which could mean that amendments might be executed without, maybe the finance and accounting team always being aware of them, or maybe being aware of them in a timely fashion. So I think this is where, good internal controls and training come into play to ensure that, any lease amendments are communicated to finance and accounting in a timely manner to avoid any errors in timeliness in financial reporting. Okay, and with that, I think I'm going to pass it along to Pam for our next polling question.
Yeah, thanks, Keith. Yep, we are now at our third polling question. Are you expecting your organization to experience significant numbers of lease modifications and/or terminations as a result of the impacts of COVID-19? A, yes. B, no, but we are expecting some modifications as a result of COVID-19, or C, no. So just as a reminder, today's webcast is eligible for 1.5 CP credits per the National Association of State Boards of Accountancy. To qualify for these 1.5 credits, you must attend for a minimum of 75 minutes and respond to at least 5 of the 6 polling questions. And as I mentioned, this is our third polling question. So I'll leave it open just for a few more seconds here just to give you enough time to respond. Don't forget to click the button next to your answer, and don't forget to hit submit so that we can record your responses. All right, and I think we're about ready to close the poll. And Keith, here are our results.
Perfect. Yeah, I was kind of interested to see kind of what the response would be on this one, just with everything going on right now. Definitely curious to see if there's been a lot of impact to leases and amendments and different things like that. That would be considered kind of lease modifications at this point. Of course, from the response we saw earlier, where a lot of folks, well, I mean, there was definitely a handful, but not as many folks that had implemented GASB 87 already as the ones that were waiting to implement until later. So might not have much of an impact at this point, but curious to see what potentially that activity is that's going on out there. So it looks like majority of you went with answers B and C, which were that, we weren't really experiencing a lot of lease modifications because of COVID-19, or a lot of you, a majority of you that aren't seeing any changes as a result of that. So I guess that's definitely some good news just with everything going on right now. Okay, so moving on, talking about remeasurement. So if you've determined that an amendment to the lease has been signed and a remeasurement of the lease liability or the lease receivable is required, the list on this slide should provide you with some thoughts on what would be considered a significant change in terms that would prompt kind of a remeasurement. And as always, you can keep the concept of materiality in mind when figuring out if the liability or receivable needs to be adjusted as a result of the changes in terms and their impact on the overall lease liability or receivable. Some of the more common items on this list I see more often than not would be kind of the change in the lease term, change in payment terms, of course, or changes in interest rates. All of those could have a significant impact on the liability or receivable, but definitely use judgment and keep materiality in mind in cases where the changes from the amendment may not have a significant impact. But if it looks like the change in terms would have a material impact, also keep in mind that you would need to reconsider the discount rate as well, as any index rates used in cases where variable payments are based off of some kind of an index. All right, so lease modifications for lessees. So what does this look like when you dig down into the actual debits and credits? Once the value of the remeasured lease liability is determined, you would adjust the current lease liability to match the remeasured liability. And then the offset to this entry would be the actual leased asset. So an example of this would be if the lease liability prior to remeasurement was, say, $50,000, and then the remeasured liability was determined to be $60,000, so you know, $10,000 delta there. The lease liability would be credited for $10,000, and the intangible asset would be debited for the same amount. Now, if for some reason the remeasured liability was lower than the initial lease liability before the remeasurement, the lease liability would be debited, and the offsetting credit would go against the intangible asset, but only to the extent that the asset is reduced to zero. So anything above and beyond that would be kind of credited as a gain, and you couldn't kind of go below zero on that. So I'd imagine that situation is probably pretty rare, but just wanted to kind of keep that in mind if anyone did run into that situation at some point, that you would have that kind of offset as reported as a gain. All right, switching over to the other side, on the lessor side, again, the accounting for this is very similar. Once the remeasured lease liability is determined, the current lease receivable is adjusted to match the remeasured lease receivable, and the offset to the entry goes against the deferred inflow of resources. And no entries would be made to the asset that is being leased, as that would kind of still remain on the books and continue to be depreciated, just as we've discussed throughout the presentation. All right, so now we want to take a few minutes to talk about the concept of lease terminations and to discuss what these really are and how they're recorded on the books. So for an example, this might be a reduction in the lease term or a reduction in the number of assets leased. So say you were renting a fleet of 20 vehicles for 10 years, but after 4 years, the contract is amended and the number of vehicles leased is reduced to 15 instead of 20. And so that would be considered a partial termination. That would require a remeasurement of the lease liability and then ultimately a reduction in the liability and the intangible asset. In a full termination where the contract is completely canceled, the remaining lease liability and the net book value of the intangible asset both would be removed, and any variance in these values would be recorded as a gain or loss upon termination. Now, if the termination is the result of purchasing the leased asset, you would record this similar as other lease modifications, where you would adjust the lease liability and the asset as a result of the change. But the only difference in that case is that the asset would need to be reclassified from an intangible asset to the appropriate asset class, such as, you know, equipment, vehicles, or building, right? So it's not being classified as a right to use intangible asset anymore. You actually put it in the actual asset class that it would go under. So on the lessor side, the biggest difference in this case for a termination resulting from the sale of an asset to the lessee, you know, in this case, the asset would need to be removed from the lessor's books, and the offset would be included with the calculation of the gain loss, which would also factor in adjusting the lease receivable and deferred inflow. Now, all other accounting for lease terminations will mirror that of the lessee side that we just talked about. I think the one nice thing, you know, again, about all of this is that once you get one side down, either lessor or lessee, the accounting for the opposite end is pretty much the same case if you enter into a similar transaction. All right, so talking about disclosures, this time on the lessee side, you know, we've gone through some of the mechanics of the journal entries and given you some things to think about when measuring the assets and liabilities, but the other key area to be aware of and the impact on is really the disclosures. There's a number of new disclosures to include in the notes, and those would be kind of different from what you might currently see under a capital lease arrangement. We've got a number of these listed on the next few slides, but I think one of the items that might be a little different from what you've seen previously would be the disclosures related to listing the lease assets disaggregated by major class. So to be able to pull this info easily, it might be helpful to have all of the lease assets tagged specifically in the system so that they can easily be identified and pulled out of the capital asset records for purposes of this disclosure. And then GASB 87 also requires that you disclose any variable lease payments that are recognized in the period, but not included in the lease liability. So if you have lots of leases or significant leases with variable payment type terms, you might want to establish a separate account or a sub-account to easily track those additional payments that aren't included in the lease liability, so you can easily pull this disclosure together at the end of the year for your financial statements. You know, anything that you can do to make implementation of the standard easier is a definite plus. So maybe consider some of those tips and tricks to use. The other significant disclosures on this next page might look similar to what you would normally see for other long-term debt disclosures, including the future maturity schedule that breaks out principal and interest payments for 5 years, and then in 5-year increments until the end of the lease. That should look pretty similar. If you don't have a lot of leasing activity, you might just decide that Excel would be fine for capturing all of this information and preparing the disclosure. But if your organization has a lot of leasing activity, you might consider using some kind of software package or existing modules you already use to track long-term debt, which could help with the information for this disclosure. You know, one example, you know, I've got a client with a significant amount of leasing activity who uses kind of an ERP system, and they're working on kind of implementing a leasing module within that system to help them track all of their leases. Now, you know, this probably isn't necessary if you only have a few leases, but if you have dozens or even hundreds of leases, you might decide to go this route. You know, one question we received at another similar training was, you know, at what number of leases would it generally be better to use software to track the leases under GASB 87? And I think the response back there is, you know, I don't think there's really a set number, but what we've suggested is to consider the risk of errors when internal controls can't really truly be effective when an accounting manager or controller is trying to review a spreadsheet that has 50 tabs of lease information. I'd say at some point it gets too difficult to rely on those manual controls to ensure there aren't spreadsheet or other kind of formulaic errors included in the calculations. So a system would be much better at making sure the calculations are processed accurately as long as someone is able to check the inputs along the way. Okay, the main difference on the lessor side is the disclosure of any revenues recognized during the period related to the leasing activity, including any revenues recorded for payments received outside of the initial lease receivable. Other than that, you would still need to include general descriptions of the leasing arrangement, future minimum lease payment schedules, and disclosure of any lessee termination options. You know, very similar to what we saw on the lessee side, and not a whole lot different there. Okay, next area that might be applicable to some of you is in relation to what's known as intra-entity leases. I can think of a handful of clients that I've worked with that have lease transactions with either blended component units or discretely presented component units. So I would imagine that some of you on the call today run into this issue as well from time to time. But the nice thing about this provision of the new GASB standard is that, you know, it doesn't really change much in terms of the current accounting for intra-entity leases. So for blended component units, and again, those would be entities that have their activity merged in with your organization, so it's basically buried in with the organization's records and is not separated out on the financial statements. You know, for those component units, you would continue to eliminate any intra-entity activity, including any lease activity. So that should be identical to the treatment for any intra-entity activity, including leases between your organization and any blended component units under current accounting guidance. But if there is leasing activity between your organization and any discretely presented component units, those transactions would be treated just like a normal lease with an unrelated third party. But the lease liability of the lessee and the lease receivable of the lessor would need to be included on separate line items. So that makes it very apparent to the reader of the financial statements that intra-entity lease activity exists between the organization and the discretely presented component unit. And again, that should be similar to the current accounting rules, with the exception of being required to present the lease liability and receivable on individual line items. So not too much effort to account for these types of transactions under the new guidance differently than what's currently being done. And lastly, before we kind of move forward into the, I guess, case study portion of the presentation, a quick note on leases with related parties. The key concept to keep in mind is to ensure the accounting reflects the actual substance of the transaction. So for example, if an organization reported as a discretely component unit, say of a city, has a one-year lease agreement with the city to lease equipment from the city, but both parties have a verbal understanding that the lease will continue for several more years. The lease should really be recorded as a long-term lease rather than a short-term lease. Another example of a related party lease might be if the organization had a joint venture with other organizations and municipalities that is maybe recorded as an equity method investment. The accounting for this would follow equity method accounting to ensure the transaction is only recognized at the organization's proportionate share in the joint venture. All right, and then with that, I think I'm going to move forward to, or pass it along to Olga to get into our first section of our pop quiz.
Thank you, Keith. All right, so what we thought would be a great idea is to set up some examples using the implementation guides and some of the other questions that we have been receiving from the clients, and set them up as situational case studies that hopefully will trigger some questions for your organization or maybe provide some answers for your organization. These are set up as a Q&A, and the answers are in the form of multiple choice. So some of these are set up as the polling question, which make sure you don't miss those to get your CP credit. And some of them you'll just have to jot down your answers all by yourself, and then we'll do a check on those. So once again, we'll get these started and then keep an eye for polling questions going forward. All right, our first question is, on December 31st, Short County entered into a 6-month non-cancelable lease with an option to renew for 12-month period, cancelable at any time by the county. The lessor does not have the option to cancel the lease. The county doesn't know at this time whether they will extend the lease. How should the county account for this lease? And our options for answers are whether we expense the lease payments for 6 months and then expense them on a month-to-month basis for another to get to the 18-month term, whether we record the asset and the liability and amortize the asset over 18 months, or whether we record an asset and a liability and amortize it over 6 months. And I'll give you just a little bit of time to kind of read through these on your own and pick your answer. In the meantime, I just wanted to let you know that we are receiving questions and answers as well as we're doing the presentation, and we're responding to those as we can. There's quite a few questions that are very complicated, so it may take a little bit longer for us to put our answer together and get back to you within the next couple of days directly with you. All right, on this first one, hopefully you have your answer selected, and the correct answer would be C. Record a lease asset and a liability and amortize the asset over the 6-month period. Now, why is that? Paragraph 16 of GASB 87 provides that a maximum possible term under lease contract of 12 months or less, including any options to extend regardless of their probability. So in this situation, we will take the 6 months original contract term and add the 12 months option, even though it's not certain that it would be exercised. However, because it is only cancelable by one party, it should be included in calculation of the lease term. All right, next question. The CD leases equipment for a term of 8 years with annual payments. The useful life of the equipment is 16 years. The total payment for the right to use the equipment over the lease term is $950,000. The fair value of the equipment at commencement of the lease is $1.6 million, and the city has incremental borrowing rate of 4%. What should the city use as a discount rate in calculating the lease liability? And our answers are in the form of a polling question. A, the incremental borrowing rate is 4%. B, the derived interest rate that equates to $150,000 of interest paid over the lease life. Or C, the discount rate explicit in the lease terms. Pam, I'll let you navigate the polling part of this question.
Sounds good, Olga. And as you mentioned, for this specific question, so this is part of our polling questions. This is poll question number 4. So we'll kind of give you some time to answer. I know some of you have submitted your responses to the previous question in the Q&A. For that one, you don't necessarily have to submit it through the Q&A, but for this specific question, this will be counted towards CPE. So please make sure to select your responses here on the screen. Select the button that best corresponds to your answer, and then don't forget to hit submit so that we can record your responses. So we'll just give you a few more seconds here. Again, you'll just need to answer 5 of the 6 polling questions, and I think we are currently on question number 4. All right, Olga, I think we can close the poll. So here are the results.
All right. Thank you, Pam. Okay, it looks like we have an interesting separation, a little bit of every answer. So the correct answer under this question would be answer B, the derived interest rate that equates to $150,000 of interest paid over the lease life. As Keith mentioned earlier, the standard really requires and prefers the entities to use the lease rate implicit in the lease, and it should be calculated. And particularly in Implementation Guide Update 2020, there's a question 415. Pass it along. That specifically says, use other avenues before you use the implicit or before you use the incremental borrowing rate of the entity. It is an option, but it is an option as a last resort. So make sure you go through analysis and determine to see whether you have information available to determine the implicit rate first before you resort to the incremental borrowing rate of your entity. So, next question. Uncertain Town leases 5 trucks from the Truck Rock Inc. The lease contract has a purchase option at the end of the lease term of 6 years. The town recorded lease asset and is amortizing their asset because they were not reasonably certain that the asset will be purchased. Halfway through the lease, they made the decision to purchase all 5 trucks, so they're exercising the purchase option. How should the town account for its decision to exercise the purchase option? The possible answers are they would remeasure the remaining lease liability and possibly adjust the lease asset amount, taking into consideration the purchase option, and amortize the lease asset of the useful life of the asset. They would remeasure the lease asset to its initial amount before amortization and remeasure the remaining lease liability, taking into consideration the purchase option. Or they would do nothing. They would continue accounting for the lease like the first 3 years. I'll give you a minute to look at these answers one more time and pick your favorite. All right, and the correct answer is answer A. So remeasuring the remaining lease liability and possibly adjusting the lease asset amount, taking into consideration the purchase option. As Keith mentioned earlier, this is one of the remeasurement situations that would require remeasuring the asset and liability. And the asset amortization will continue or depreciate over the useful life of the asset once the asset is purchased. All right, question number 4. Zootopia County leases equipment from Night Howlers, Inc. The equipment will not function until properly installed. Zootopia selected Night Howlers to install the equipment for an additional $15,000. Gazelle Installation had the next highest bid to install the equipment for $16,000. The lease contract requires Zootopia to pay the lessor for installation in year 3 of the lease term. How should Zootopia record the installation costs? And our answer options are add the installation costs to the lease asset and increase the lease liability, add the cost to the lease asset and increase trade AP, expense the cost and increase the lease liability, or expense the cost and increase AP. So once again, this is what do we do with the installation costs that are required in order for equipment to become functional. All right, and the correct answer would be answer B. The installation costs would be added to the cost of the asset and increase trade AP. According to the GASB 87, the initial direct costs are not included in lease liability. The installation cost would be considered not part of the lease component. And there are necessary charges for the equipment to operate, therefore they will increase the asset value that will be depreciated. All right, our next question. Power Cities Electric Fund enters into a joint use agreement for the purpose of sharing the use of its poles with the local telephone company. The agreement is month to month, and the fund has no intention of terminating the agreement. Both parties to the agreement have the ability to cancel the lease at any time. The control criterion outlined in paragraph 4 of Statement 87 is met, as the local telephone company has the control over the connection point for which their equipment is attached. How should the electric fund account for this arrangement? Now, possible answers are the agreement meets the definition of the lease per GASB 87, and lease asset and related liability should be recorded and accounted for in accordance with the standard. B, record as short-term lease and record revenues based on payment provisions of the agreement. Or C, the agreement doesn't meet the definition of the lease and should not be recorded as such. All right. Hope you have your favorite picked, and the correct answer is answer B. It would be recorded as a short-term lease, and revenues would be period-based on the provisions of the agreement. So this is a situation where both lessee and lessor had the option to terminate the lease at any time. So the lease would be considered having cancelable periods. Therefore, it would be considered a short-term lease, because cancelable periods are excluded from the lease term. All right, with that, Keith, would you like to take over question 6?
Question 6 of the pop quiz. Hopefully everyone's doing good so far. Just a quick reminder again that not all of these are polling questions, so you don't have to worry about not being able to answer some of these through the polling mechanism. But I think we've got 2 more of these that will be polling questions, but I don't think this question 6 is. So for this one, the scenario is Public Works Fund is granted temporary easements from various property owners for the purpose of accessing the land to complete a specific construction project. The easements permit Public Works to access the land during the 24-month non-cancelable period and control the use of the land during that period for purposes of construction. So the question is, how should the easements be recorded? So I know on these questions there's a lot of information and stuff, so I'll just pause there for just a second, let you kind of soak that in, and then move forward here into the possible answers. So it could be A, easements are scoped out of the provisions of GASB 87. B, easements do not meet the definition of a lease. An intangible asset should be recorded and amortized over the 24-month period. Or C, the temporary easements meet the definition of a lease under GASB 87, and a lease asset and related lease liability should be recorded. So think about that for a second, which answer you would go with. Again, not a polling question right here. And then moving on to the correct answer would be C, the temporary easements do meet the definition of a lease under GASB 87, and a lease asset and related lease liability should be recorded. So some more background behind that response. So you want to always kind of go back to paragraph 4, and I think, Olga opened up with kind of the definition of a lease and said, hey, I have to read through this because there's all these different components and stuff. I mean, that is true. You kind of want to go back to this and some of these basic concepts, but there's a lot of moving pieces within it. So in paragraph 4, the lease is defined as a contract that conveys control of the right to use another entity's non-financial asset for a period of time in an exchange transaction. So, control determinations, that was kind of all met in that scenario that we looked at for these temporary easements. But the other key piece for these is that because they're temporary easements, it meets that portion where it says that, right to use another's entity's non-financial asset for a period of time. So you have to have that kind of defined period of time. It can't just be in perpetuity, as we've mentioned. So temporary easements can and do meet the control criteria above, but permanent easements, if we had switched that scenario and said that they were permanent easements, those are not considered leases because they don't meet that specified time criteria above. So kind of keep that in mind. All right, moving on to question 7, and I think this one will be a polling question, so hold off for that just a second, but soak in the information here on this scenario. So Wind Airport Authority has a lease contract with an airline. The contract includes a space for terminal use that meets the definition of aeronautical use as defined by Federal Aviation Administration, as well as office space used for non-aeronautical use. How should the authority account for this agreement in accordance with GASB 87? So soak that up, and I will pass this along to Pam for the next polling question.
Great. Thanks, Keith. So based on the facts on that previous slide, how should the authority account for this agreement in accordance with GASB 87? A, treat the entire agreement as one lease and record a lease receivable and a deferred inflow of resources. B, treat the entire agreement as a regulated lease that is excluded under paragraph 43 of GASB 87. Or C, evaluate each component of the agreement as separate aeronautical and non-aeronautical and treat each component separately under GASB 87. So we'll give you a couple of seconds to select, the answer that you choose. Again, don't forget to hit submit. This is a polling question, so this will count towards CPE. I think this is our 5th polling question, and we'll have one more here for today's session. So I'll leave it open for just a couple more seconds. And then also just as a quick reminder for those of you who are looking for today's slide deck, you can download a copy of that in the folder that says slide deck and handouts to the right of the slide view. We'll also, if you have any difficulty downloading them today, we'll also be sending you a copy via email. Okay, so I think we're ready to close this poll. And Keith, here are the results.
Okay, looks like most of you said option C, evaluate each component of the agreement as separate aeronautical and non-aeronautical and treat each component separately under GASB 87. And that response, as we move forward, is the correct response. And the reason for that, and I don't know that we touched on this too much in this presentation, but definitely a good thing to be aware of, the portion of GASB 87 that talks about contracts with multiple components. So you want to separate contracts into any lease and non-lease components, or when there's multiple lease components, kind of separate those out, and separate any regulated components from non-regulated components in this case. And that was part of this scenario as well. So you want to be able to kind of separate those out. So that's the important piece, and that was what was kind of triggering the answer with this one. All right, moving on to question 8, just a couple more of these. In this case, it's intra-city utility, which has both an electric system and a water system that are segmented in the utility's general ledger and on its annual financial statement report. The utility recently constructed a new operations facility that was paid for with funds entirely from the electric system, and the facility is utilized to support both electric and water system operations, and therefore the utility has established an intra-entity lease agreement between the electric system and water system. And in that case, the electric system charges the water system rent for its use of the facility. So based on that scenario, how should the utility reflect these transactions in the annual financial statements? So read through that again, think about it a little bit, and then we'll go ahead and here move forward into the possible answers. So A, even though the electric and water system are segmented, the utility also presents a consolidated system column in its annual financial report, which would eliminate all this activity. Given the lack of impact on a consolidated level, nothing needs to be recorded. Or B, the electric system, which is the lessor, and the water system as the lessee, would record the transaction as a lease in accordance with GASB 87 in their respective individual columns in the financial report. And then any eliminations would be made to remove the impact of this on a combined system level. Or response C, intra-entity leases are scoped out of GASB 87. So think which of those, based on the scenario, you would go with if it were a polling question. And we'll move forward to the actual answer, which is B, the electric system and water system would record the transaction as a lease in accordance with GASB 87, individually in their respective columns in the financial report. And then you would have eliminations kind of to remove that intra-entity impact on a combined system level. And that kind of goes back to what we talked about with intra-entity leases. In this case, it's a utility that's got kind of multiple systems, or you could think of them as funds that are displayed on a standalone basis within the annual financial report. And this kind of goes back to what we talked about with if you had a discretely presented component unit. Now, that's not the case of what this is, but it kind of functions similarly, where you have these separate columns with these, in this case, separate systems that are treated. You kind of show their standalone kind of financial position, their own kind of statement of net position on there individually. So you'd want to treat each of those as its own kind of standalone entity almost, and you record those lease transactions in accordance with GASB 87, just like you would do with a discretely presented component unit. And then you'd have, the separate line items for the lease receivable and then the lease liability, and then you would have the eliminations kind of for the total column, right? That kind of combines everything together. So that kind of goes back to what we talked about with intra-entity leases and what's driving the answer for this one. All right, this is our last one. This one will be a polling question as well. Question number 9. Due to the new operations facility, Intra-City is utilizing, it has been able to transfer a significant number of employees to the new building, and that's leaving an entire floor empty at its old building. Intra-City decides to lease a portion of the building to a third party. The third party then falls on hard times and has to renegotiate a new rental payment with Intra-City. The amendment is signed and then impacting the present value of lease payments expected from a total of $300,000 down to $225,000. So in this case, how should Intra-City account for the impact of this amendment? So again, we'll pause there, let you kind of read through that another time real quick. And then I'll go ahead and pass it along to Pam for our final polling question.
Thanks, Keith. Yep, and we'll kind of just leave this question open here just to give people some time to kind of just look through the information, and then I will turn it over where you can see the list of possible responses. So here's the polling question. So based on the facts on the previous slide, how should Intra-City account for the impact of this amendment? A, the amendment is not considered a new lease, and therefore the lease receivable and the deferred inflow should be reduced by $75,000. B, reduce the lease receivable by $75,000 and simultaneously record a $75,000 expense. The deferred inflow should remain at $300,000 and be amortized according to the original agreement. Or C, record the transaction as a new lease and follow the guidance under GASB 87 to record the initial lease receivable and related deferred inflow. So I'll give you a couple of seconds just to think about that. To select your response, please click the button to the response you choose. Again, don't forget to hit submit so that we can record your responses. So as a reminder, today's webcast is eligible for 1.5 CPE credits, and you must attend for a minimum of 75 minutes and respond to at least 5 of our 6 polling questions. Now, once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window, which you should see to the right of the slide view. All right, just a few more seconds here, and then we'll be closing the poll. All right, Keith, here are the results.
All right, thanks, Pam. Looks like most of you went with response A, which is that the amendment is not considered a new lease, and therefore the lease receivable and the deferred inflow should be reduced by $75,000. And if we move forward to see the actual answer, which is A. So I think a good chunk of you got that one right. And this kind of goes back to what we talked about with lease modification. Oops, I guess I don't have a slide that talks about that. But it goes back to lease modifications, right? And if you're not actually through kind of an amendment, which there was an amendment in this case, but if through an amendment you're not actually leasing kind of a new asset or anything like that, then you don't have a new lease or anything like that to record. You just kind of remeasure the lease receivable in this case and adjust it from there. And so that's what's driving the answer for this one. Okay, and with that, I think that takes us through all of our kind of case study type questions for you guys. And now I'm going to pass it along to Olga to go through some closing remarks that we have.
Okay, thank you, Keith. All right, just a refresher on effective dates. Once again, the original standard was, the original implementation date was for reporting periods beginning after December 15, 2019. So we would all be in the midst of that implementation right now, and some of you have gotten an early start in the last year or even 2. Especially if you have, a large number of leases or contracts to analyze. The first update to the effective date came through the change through the Omnibus 2019, and it changed the terminology from reporting periods to fiscal years. And that was done in order to allow some governments that do interim reporting under GAAP, such as quarterly reporting, to wait until their full fiscal year to implement the standard. And of course, we're all happy to see GASB 95 that allowed the postponement of implementation dates for GASB 87 for 18 additional months. So good year and a half to continue and test your established processes or get started if you're a little bit behind on analyzing the contracts you have in place. Now, as I said, I have worked with several entities, and we have received questions from clients who have started the implementation, working on the implementation of the standards, and some of the best practices that have developed from that work is really just focusing on, I would say, focusing on internal control processes, because evaluation of contracts is going to become an additional business process similar to what you have for your revenues or expenses or payroll and so forth. So really establishing the internal control framework to make sure that all contracts are being evaluated for potentially meeting the lease criteria, that once set up, the contracts, the leases, are evaluated or reviewed regularly to make sure that if the lease amendment or lease termination or remeasurement needs to be happened, that's captured timely, and appropriate approval or approvals present during that process. And of course, the calculation of the lease asset or liability and related components is performed accurately and reviewed by someone independently of the person performing the calculations. So we would suggest to really look at those internal control processes that allows you not only in the implementation in year one phase to set up all of the leases correctly, but have that internal control system helping you throughout the years. So the first recommendation we have is ensure proper setup and monitoring of user access to modules or spreadsheets utilized for tracking leases. Some of you may be entering into agreements for some additional software purchases if you have a lot of leases and you really need a robust program that does the lease analysis. Some of you may be just doing a spreadsheet, using a spreadsheet to evaluate those. So making sure that, especially if you're using the spreadsheet, that it is controlled in some way, that only persons authorized are able to make modifications to that, as well as have certain points of approval and how that's documented, just thinking through that and establishing that process. Second is establishing clear roles for preparation and approval of lease determinations, calculations, and journal entries. Once again, we're looking for segregation of duties here. There's going to be individuals responsible for negotiating the leases. How does that information get communicated to the accounting and finance group that will actually be responsible for capturing those leases, performing the evaluation, capturing the relevant terms, and having that information flow through into the financial statements. So really understanding who are the responsible people within that process. Another one is identify and consider potential changes in types of revenue that would impact financial covenants and calculate the ratios based on implementation of 87. Of course, what used to be just simply a lease revenue or lease expense is now going to become separated into the expense as well as the interest expense or interest revenue, which is a non-operating component. How does that impact the evaluation? I have had several conversations with my clients and their bond counsels about how do the bond counsel view the classification and the change in how those costs are going to be, costs or revenues will be reported for purposes of a debt covenant calculation. So have that conversation with your internally debt service group or externally with your bond counsel to make sure that you're not missing out on any, or you will not miss out potentially on any of the debt covenants that once those categories of revenues and expenses change. Another one recommendation we have is consider whether other changes to internal control systems are necessary. Once again, especially if you have more of a manual process where a lot of individuals are involved and you just have a spreadsheet that captures the information for lease evaluation, make sure those roles are very well defined and documented and everybody understands those. It may require some internal training as well. So consider that communication that needs to be occurring throughout the organization, not just within the accounting and finance group, but throughout the organization as well. Consider any advantages of IT. So for example, even if you're not obtaining some robust new software to keep track of your leases, you still could use some electronic help, if you will. For example, saving leases as searchable PDF files or setting up bookmarks on the pages of the contracts that have documented relevant terms or potentially remeasurement provisions. So having those available, searchable, and available to be extracted when those events occur, or having flagged those events for evaluation when they're expected to occur and capturing them timely. There may be some IT help available for that. Consider whether the requirement should be placed whether all contracts are scanned and indexed in a central repository, especially those that are determined to be leases. So there is a uniform process throughout the organization of where all of those leases are maintained, and some kind of a calendar check set up for when they need to be checked for potential options renewals, terms changes, cancellations, and so forth. You may consider utilizing an existing debt management software to assist you with generating the amortization schedules and creating journal entries. Particularly if you have a lot of leases, it may become cumbersome in maintaining those amortization schedules in the Excel spreadsheet. So see what other potential capabilities your software has. A little bit more on internal controls. Communication is key. As we say, the individuals negotiating the agreements are often those outside of the accounting and the finance department, and sometimes the accounting group is the last one to find out when a new contract was entered into. So making sure that the individuals from accounting and finance, maybe designated champion, is always involved in a contract negotiation to really think about, bring their perspective of what this potential contract, how it would be reflected in the financial statements, what impact it would have on revenues and expenses, remeasurement, and other aspects, key aspects that could have financial statement impact. New policies, amendments to existing policies. As I mentioned, many of our clients have come forward and actually established a full-on policy or a full-on implementation guide to really make sure and socialize that document throughout the organization so everybody understands the roles and responsibilities and key controls within that process. So that may be something that your organization could consider. When it's in writing and individuals are designated and responsible, it's easy to train everyone across the organization and really have clear understanding of roles and responsibilities. Do keep in mind the segregation of duties, of course. Once again, who is negotiating and approving the agreements, who is getting those agreements and performing a full evaluation under GASB's 87 standard, who is then taking what's determined to be a lease and calculating the asset and the liability and putting it into an amortization schedule. So all of those individuals, there has to be a level of review in addition to the person that's preparing those records. So make sure that you have that review component established. And of course, as I said, monitoring and reviewing amortization schedules, especially as they change. Some amortization schedules may not need to be changed for several years. Some may need to be reviewed annually. So really establishing a timeline for how often those need to be reviewed and make sure the terms are still consistent and correct. One interesting concept that has been brought up several times in the presentations that I have been to by GASB is that, GASB 87, as well as all GASB documents, have this box at the end of the standard that says the provision of the standard need not be applied to immaterial items. And they really stress this as, do think about what is a material lease for your entity, and does it, if you only have one, or is there a certain small number of them that you could be excluding as immaterial for the purposes of implementation of GASB 87? I think that was also one of the questions that we got from participants on this presentation is, what exactly is material or immaterial lease for the purposes of this consideration? And, the favorite answer of the accountant, of course, is it depends. It depends on the size of your entity, it depends on the type of the lease, it depends on the terms of that potential lease. So it really is judgmental, and it's based on professional judgment. What I would suggest is talking to your auditors and really thinking about what leases can we exclude as immaterial, just to avoid the cost benefit for accounting. Those may not be there. I have had several clients that brought to me a plan for what they think is immaterial and asked me as their auditor to evaluate whether we as the auditors would be comfortable and agree with that. So I think this is a collaborative conclusion, if you will, that you can start discussion with your auditor to determine which leases you can consider immaterial. There were several questions regarding capitalization thresholds. So, for example, if your capitalization threshold for the organization is, let's say, $5,000 for capital asset, could you use those thresholds as determining what's material and what's immaterial? GASB implementation guide actually has addressed that in question 24.23. You can take a look at it. What their view is that consider quantitative and qualitative factors of that lease. Consider whether there's only one lease, or there's a difference if you have one immaterial lease or 100 immaterial leases together collectively, which would become material. And also consider whether you have an asset or a liability. Something that's immaterial as an asset may become a different discussion if it's in a liability. So some of the things to think about, but once again, I think this is a conversation you can definitely start if you haven't already with your auditor and come to a conclusion that will hopefully save you some time. And with that, unfortunately, I think we're out of time. Pam, I don't know if we have a minute or two of any easy questions that we can address right now, or we can address those and follow up with individuals after this call as well.
Yeah, I think we can probably follow up after this call, Olga. I just wanted to say thank you to Olga and Keith for a great presentation today. And like we mentioned, unfortunately, we're out of time today, but if you submitted a question that we did not get to, we'll do our best to follow up with you after the webcast. Or you may also reach out to our presenters directly if you didn't get a chance to submit a question today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Also wanted to share a couple of resources for you to, view, to visit our website when you have some time. We've done a whole series of webcasts for our government services practice. Feel free to visit the site. You can view some on-demand webcasts that we have in case you missed some of those webcasts. We also have some COVID-19 resources, and we have included links here. And of course, if you'd like to subscribe to our content, to receive notification for future webcast invitations, or just subscribe to our articles and alerts, there's a link here where you can sign up. And then one more thing, here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete the survey, as your feedback is very important to us. Thank you again for joining us, and we hope you'll join us again next time.